what is happening in the world of digital assets right now? You are not going to want to miss these updates, folks. The market is moving at lightning speed, and we've got the breaking news you need to stay ahead of the curve. From groundbreaking initiatives in sovereign nations to massive shifts in institutional strategy, and even some seismic activity from the biggest players in the game, it's all unfolding before our eyes. Get ready, because this is your essential briefing, your pulse on the pulse of innovation and disruption. We're diving deep into the stories that are shaping the future, the ones that will define the next era of finance and technology. Don't blink, you might miss it. Stick around, because you're about to get the inside scoop. First up, we're heading to Honduras, where a pioneering Bitcoin City project is forging its own path. While its neighbor often grabs the headlines, this initiative is older, more established, and is creating a unique environment where life can be lived entirely on Bitcoin. We'll break down how this ZEDE is attracting investment and what its innovative tax and governance models mean for the future of economic development. Then, we're tracking a significant capital shift that could redefine the crypto landscape. Institutions are making moves, and the data suggests a powerful rotation is underway from one major digital asset to another. What does this mean for your portfolio and the broader market trajectory? We've got the analysis you need. And finally, we're witnessing massive whale activity that's sending ripples across the market. Billions in profits are being moved, sparking debates about manipulation and potential corrections. Plus, we'll explore why a classic digital asset is seeing a surge in institutional interest over another long-standing store of value. Don't miss any of it. And hey, if you're new here, make sure you hit that subscribe button and ring the notification bell so you never miss an update. Honduras Bitcoin City breakthrough. Honduras is charting its own course in the digital asset revolution with its pioneering Bitcoin City project, Prospera. While El Salvador's initiative often dominates the headlines, Prospera, located on the Caribbean island of Rotin, is actually the older and more established of the two, conceived over a decade ago with a bold vision: a city where residents can live entirely off Bitcoin. This ambitious undertaking is not just about cryptocurrency. It's a testament to innovative economic models designed to combat poverty and attract foreign investment to less developed regions of the country. Prospera operates as a zone for employment and economic development, or ZEDE, a legal framework established to foster economic growth. Founded by Venezuelan entrepreneur Eric A. Bryman, who was inspired by the stark economic disparities in his home country, Prospera aims to create a pathway out of poverty through economic opportunity and technological adoption. The project received its crucial approval from Honduras Supreme Court back in 2013, and since construction began in earnest in 2021, it has already become a catalyst for business growth, launching over 200 companies and securing more than $100 million in investments. What truly sets Prospera apart is its unique financial and governance structure. The city boasts an incredibly attractive low taxation model, featuring a mere 1% income tax, a 5% personal income tax, and a 1% land value tax. For residents and businesses, this translates into a significantly more appealing financial environment. Moreover, Prospera has fully embraced cryptocurrency, integrating Bitcoin into the very fabric of its economy. All transactions, including tax payments, are processed seamlessly using Bitcoin, allowing residents to complete payments in seconds simply by scanning a QR code with their digital wallet. This efficiency has been lauded, with one resident noting that tax returns, a typically cumbersome process, can be completed in under 5 minutes. The governance model is equally distinct. Prospera enjoys a semi-autonomous status, allowing it to operate with a degree of independence from the Honduran national government. Its administration is handled by an anonymous council, and disputes are resolved by an arbitration court comprising former U.S. judges, with private security firms tasked with enforcing the city's regulations. However, this innovative model has not been without its challenges. Prospera, like other ZEDES, faces significant political headwinds. The initial champion of ZEDES, former President Juan Orlando Hernandez, is now extradited to the U.S. on corruption charges, leading to a decline in political support. President Xiomara Castro, who campaigned on a promise to abolish ZEDES, has publicly criticized them, aiming to shed the nation's banana republic stereotype. In 2022, Honduras Congress voted to repeal the ZEDE law, but international treaties provide Prospera with protection for at least 50 years, preventing its immediate closure. In response to the government's actions, Honduras Prospera Inc. has filed a massive $10.775 billion lawsuit against the Honduran government at the International Center for Settlement of Investment Disputes, ICSID, a sum equivalent to nearly two-thirds of the country's annual budget. With ICSID often favoring corporations in such cases, the outcome of this legal battle could have far-reaching implications. But this pioneering city is navigating turbulent legal waters. Next, we're shifting gears to explore a major capital reallocation that's shaking up the institutional investment world. Institutional capital flows, the Ethereum surge. The cryptocurrency landscape is witnessing a significant strategic realignment as institutional investors appear to be shifting substantial capital away from Bitcoin and towards Ethereum. This trend, observed through on-chain data and market analysis, suggests a potential new phase in digital asset allocation, where the second-largest cryptocurrency is increasingly favored for its robust ecosystem and evolving utility. The implications of this institutional rotation could be far-reaching, potentially influencing market dynamics, asset valuations, and the overall narrative surrounding the dominant digital assets. For years, Bitcoin has been the primary gateway for institutional capital into the crypto space, often viewed as a digital store of value akin to gold. However, recent market movements indicate a growing appetite for Ethereum, driven by several key factors. Ethereum's ongoing transition to a proof-of-stake consensus mechanism, culminating in the successful merge, has significantly reduced its energy consumption and introduced staking yields, making it more attractive from an environmental, social, and governance (ESG) perspective. Furthermore, the continuous development of the Ethereum network, including Layer 2 scaling solutions like Optimism, Arbitrum, and Polygon, is enhancing its transaction speeds and reducing costs, thereby improving its utility for decentralized applications, DApps, decentralized finance, DeFi, and non-fungible tokens, NFTs. Analysts point to the increasing number of institutional-grade custody solutions and derivatives products being developed for Ethereum as further evidence of growing institutional confidence. The advent of Ethereum futures ETFs in various jurisdictions has provided regulated avenues for institutional investors to gain exposure. Moreover, the network's vast developer community and the sheer volume of innovation occurring within its ecosystem, from DeFi protocols to metaverse projects, present a compelling case for its long-term growth potential. The rotation isn't necessarily a repudiation of Bitcoin, but rather a strategic diversification and a recognition of Ethereum's distinct value proposition. While Bitcoin remains a strong contender as a digital gold, Ethereum is increasingly being positioned as a digital oil or a decentralized internet infrastructure, powering a wide array of applications and economic activities. This shift could lead to increased demand for ETH, potentially driving its price appreciation relative to Bitcoin in the short to medium term. Market observers are closely monitoring metrics such as net exchange flows, futures market open interest, and staking data to confirm the scale and sustainability of this institutional rotation. Early indicators suggest that large investment firms and asset managers are not only increasing their Ethereum holdings, but also actively participating in staking, seeking to earn yield on their crypto assets. This move towards yield generation is a hallmark of mature investment strategies and signals a growing sophistication in how institutions approach the digital asset market. The narrative is evolving from a binary Bitcoin-centric view to a more nuanced understanding of the crypto market, recognizing the distinct roles and potential of different digital assets. Ethereum's programmable nature and its foundational role in Web3 development make it a critical piece of the emerging digital economy. As more institutions allocate capital, the demand for ETH is likely to intensify, potentially creating a significant capital inflow that could reshape market capitalizations and investment strategies across the board. This institutional pivot is creating significant market momentum. Now, let's dive into the dramatic moves by Bitcoin's biggest players that have everyone talking. Whale warfare, $4 billion profit dump and market manipulation fears. Bitcoin's market has been sent into a frenzy by a massive profit-taking event orchestrated by its largest holders, commonly known as whales. In a single day, these behemoths realized approximately $4 billion in gains, marking one of the most significant single-day profit-taking events seen in recent history. This colossal sell-off has ignited widespread concerns about market manipulation and the potential for a sharp, short-term correction. The sheer scale of these transactions, particularly the contribution from accounts holding over 10,000 BTC, suggests a coordinated effort to capitalize on recent price surges, potentially at the expense of retail investors and the broader market stability. Crypto analytics firm Crypto Onchain reported that accounts with more than 10,000 BTC were responsible for $2.17 billion of the profits, while those holding between 1,000 and 10,000 BTC added another $1.25 billion. Even smaller whale accounts, holding 100 to 1,000 BTC, contributed $495 million. Such concentrated selling pressure, typically observed near market peaks, has led many analysts to believe that a period of consolidation or a significant price pullback is imminent. Adding fuel to the fire, a prominent whale, dormant for over 5 years, reactivated its wallet and proceeded to sell a staggering 24,000 BTC. This single transaction alone is believed to have contributed to a sharp price drop of around $4,000 over the weekend. The same whale has since moved an additional 25,000 BTC, further intensifying speculation about its intentions and the potential for continued downward pressure. Experts suggest that such large-scale movements, especially during periods of lower weekend liquidity, are often strategically employed to maximize market impact and potentially trigger cascading liquidations in the derivatives markets. The market's reaction has been mixed, with some data indicating a cautious re-entry by major holders. While the massive profit dump paints a bearish picture, other on-chain metrics reveal a more complex scenario. For instance, large buy orders have recently begun to outweigh sell orders across major exchanges like Binance, OKX, and Coinbase, with net Bitcoin buy orders reaching approximately $13 million in the past 24 hours. The derivatives market has also seen net buys of around $275 million. Furthermore, a notable spike in Binance inflows, with a 7-day moving average of 13.5 BTC per deposit, is often an indicator of whale activity, potentially signaling further price suppression in the short term as these large holders reposition themselves. However, the long-term holder base, often referred to as OG whales, who accumulated Bitcoin in its nascent stages, are beginning a gradual divestment. This slow sell-off introduces volatility as large blocks of Bitcoin are absorbed by markets with fluctuating demand. The overall picture is one of transition, where institutional investors and new market participants are gradually increasing their share of holdings. This shift, while potentially beneficial for long-term liquidity and decentralization, creates short-term price turbulence. The risks associated with leveraged positions remain a significant concern. This past week alone saw over $513 million in leveraged long positions liquidated, with short positions incurring over $114 million in losses. Key liquidation levels are being closely watched, particularly around the $108,000 mark for leveraged longs, highlighting the fragility of positions in this volatile environment. Despite the immediate turbulence caused by whale activity, the underlying fundamentals of Bitcoin, including its robust stock-to-flow model and increasing institutional adoption, continue to support a long-term bullish outlook. However, the immediate future is likely to be shaped by these large-scale movements and external macroeconomic factors, such as potential interest rate adjustments. These massive shifts from major holders are creating waves of uncertainty. But what about the established players in traditional finance? Let's see how they're aligning their strategies. Digital gold versus digital scarcity. the institutional allocation shift. In a compelling development for the future of investment portfolios, institutional investors are increasingly favoring Bitcoin over gold, marking a significant shift in asset allocation strategies for 2025. This trend underscores a growing recognition of Bitcoin's unique properties as a digital store of value, often dubbed digital gold, and its ability to hedge against traditional market volatilities and inflation. As economic uncertainties persist and traditional assets face headwinds, institutions are actively seeking alternative investments that offer robust growth potential and uncorrelated returns. Bitcoin, with its inherent scarcity, decentralized nature, and increasing adoption by major financial players, is emerging as a primary candidate for this strategic reallocation. For decades, gold has been the go-to safe haven asset, a benchmark for wealth preservation, and a hedge against economic downturns. However, the digital revolution has introduced a new contender that possesses characteristics many find superior for the modern investment landscape. Bitcoin's supply is capped at 21 million coins, a hard limit that ensures its scarcity, a trait highly valued in an era where central banks can print fiat currency at will. This predictable and finite supply contrasts sharply with gold, whose supply can fluctuate based on new discoveries and mining capabilities. Institutions are not only attracted to Bitcoin's scarcity, but also to its portability, divisibility, and the technological infrastructure that supports it. The ease with which Bitcoin can be transferred globally, stored digitally, and divided into smaller units makes it a highly practical asset for large-scale investment. Furthermore, the development of regulated investment vehicles, such as Bitcoin ETFs and futures contracts, has lowered the barrier to entry for institutional capital, providing familiar and compliant avenues for exposure. This regulatory clarity and accessibility are crucial factors driving the adoption of Bitcoin by pension funds, asset managers, and corporations. The narrative surrounding Bitcoin as digital gold has gained significant traction, particularly in light of recent global economic events, including inflationary pressures and geopolitical instability. Investors are increasingly viewing Bitcoin not just as a speculative asset, but as a strategic hedge that can preserve purchasing power over the long term. Its performance during periods of market turmoil, while sometimes volatile, has often demonstrated its resilience and its ability to decouple from traditional market correlations. Conversely, gold, while still a valuable asset, faces challenges in the current environment. Its physical nature makes it less portable and more difficult to manage for large institutions compared to digital assets. While gold has historically served as a reliable store of value, its price movements can be influenced by factors such as interest rate changes, currency fluctuations, and physical market dynamics, which may not always align with the needs of modern institutional investors seeking digital native solutions. The shift in allocation is being driven by a combination of factors: a desire for higher potential returns, a need for diversification in a low-yield environment, and a growing conviction in the long-term viability and adoption of digital assets. As more institutions embrace Bitcoin, it validates its position in the global financial system and reinforces its status as a legitimate asset class. This trend is likely to continue as the digital asset ecosystem matures and regulatory frameworks become more comprehensive, further solidifying Bitcoin's role as a preferred alternative to traditional safe haven assets like gold. This strategic pivot highlights a major trend in how institutions are viewing value. Now, let's wrap up with a quick recap of all the key updates you need to know. And that's a wrap on another packed episode. We saw Honduras Bitcoin City forging ahead with its unique economic model. Institutions are making a big play, rotating capital towards Ethereum. Bitcoin whales made massive profit dumps, causing market jitters, and institutions are increasingly choosing digital scarcity over traditional gold. Don't forget to smash that like button, subscribe for more essential updates, ring that notification bell, and let us know your thoughts in the comments below. You can also follow us on all our social channels for real-time news. We'll see you in the next one.